But Ajay, if I could toss it to you, I know, I mean, I don't want to push you to comment specifically on a certain company or stocks, but generally speaking, I mean, this kind of M&A action, how do you think the market will take it? Does it have the appetite to digest these sort of deals? Because along with the cash outgo, there's also, a corporate guarantee for the debt restructuring.
Yeah, see how market would look at it, Surbhi, is what is the valuation, what are the cash flows you're getting, what are the talent pool that you're getting. Companies like this, the maximum outgo is on people, normally the designers and the expert technicians would be the real talent pool that you're getting. So clients will be a few, what I've seen reported only Rolls-Royce or Ferraris and all of the world. So it'll be a few clients where you have access to clients like that in terms of knowing who they are. So it doesn't really, we'll have to see clearly. I cannot comment more than that. Let the full details come out tomorrow.
Okay, Ajay, that's on TechM and Mahindra. We should get those interesting stock reactions going tomorrow. But before we got into that phone conversation, I had cut you short on the market answer. What is spooking the Lal Street? And more importantly, it's the Fed week. If we go with the assumption that we're going to finally get that 25 bips hike, then what can we expect? I mean, is this volatility going to be the norm for the next 2-3 days?
Well, at least for the next 2 days, till Madam Yellen comes and announces at the press meet, or just before that we get the ticker out. I think till then, so next 48 hours will be very volatile. Post that, it will be okay. We are done with a very big event, and then focus on the other things. Global turmoil is there, be it the oil price. Again today, Brent has gone down to a 7-year low. So oil price, the yuan devaluation, China has played well in terms of calibrating the devaluation. So 4% devaluation they have achieved even before the US dollar move. And, they are kind of depegging themselves from the dollar move. And then the junk bond issues that are emerging in the US, how bad will that get? There's Howard Marks on one side who's calling it the opportunity of the decade post-2008 Lehman. He's saying this is the biggest distressed debt opportunity I have seen. A lot of respect for him, very experienced value investor. On the other side, you have Third Avenue and other funds like that who are stalling redemptions now. So clearly that is an emerging situation which could roil markets. And at the base of that is again the oil. The oil industry, highly leveraged, especially the shale gas in the US. Cycle to cycle, 2006 to now, hardly anybody has made money in that industry. So a lot of money at stake there, a lot of bonds, corporate defaults anticipated there. That's again an emerging situation. So clearly should be a difficult situation for global markets, but at least with the Fed hiking, one event will be out, and then the focus will be on the commentary. I'm sure she'll come out and say we are looking at it moderately, we're looking at moderate increases and very calibrated increases. That's the language we are expecting. Today, Draghi has done his job. While speaking in Italy, he said, we'll do whatever it takes once more. He has brought his bazooka and kept it on the table in full visibility of everybody. So with that, and then you have got Bank of Japan later in the week. So let's see what Kuroda comes out with. Very interesting times.
Absolutely. Central bank action all the way, driving markets. Speaking of central bank action, well, this is today's fund flow picture. Let's get you the graph. FIRs are back to their selling ways. If you thought Friday was a change of trend, well, there's been no follow-up today because they've gone ahead and sold stocks worth 157 crore rupees in the cash market once again. Domestic institutions continue to be net buyers. They've bought equity worth nearly 400 crore rupees in the cash market. Still not quite enough because we've seen such intense volatility, but at least scraping up and moving higher. Ajay, in a market like this, would you advise buying anything at all right now? Should one sit out for the next couple of days on cash? And you mentioned oil, so I want to get your specific take on the short covering bounce that we're seeing on stocks like Hindalco, on Kane India, even Reliance moving higher in the last couple of sessions. So what to do with this entire basket?
I think one thing that's coming out should be quite clearly, and if you see the oil complex even today, especially the big producers and refiners getting hammered, I think stay away from the oil marketing company. That's a change of stance. I have been saying we are bullish on oil marketing companies given the oil reforms have happened in India. But you're looking at inventory losses again this quarter. So I would say stay away from the refiners. The producers, clearly, with these kind of prices, they are in trouble. So it's a smart money with a 3-year horizon, which can look at commodities and oil. I would say not for the retail investors, not for you and me. You will find better price value equations. This is a good value, but it can become a value trap very soon. So there is a glut. And look at it this way. Today there is data out. Our understanding was that Saudis would play ball till about $15. Now the understanding is that $3 is their marginal domestic onshore cost of production. They are going to keep playing this like they did in '86, where they brought down oil right down to $10. So they are out to cripple all other producers. Russians' marginal cost is about $15. So you are, I think, looking at a lower oil. $20 is not really out of the realm of possibility. So,
well, Ajay, I guess a market like India should be rejoicing if those sort of numbers come close to being anywhere true. But I guess we're looking at a different scenario here in the market.